Hello accounts people, time to have a look at depreciation, focusing on requirements for advanced bookkeeping. So we know that most assets depreciate, in other words they lose value over time. So the amount of value it loses is an expense to the business. If something isn't worth what it was a year ago, it's cost us. It may be that we're saving up to replace it, for instance. So the definition is a systematic reduction of the value of an asset. In other words, systematic means we're going to apply one of the appropriate methods and calculate how much to charge to the profit or loss account, in other words the annual expense, income and expense account of a business. So we have to comply with International Accounting Standard 16, property, plant and equipment. That's where the definition comes from, that's where all the rules are. And then also the accruals concept. So this means charging the appropriate amount to the years of use. So if we own an asset or control it for 5 years, we break the cost down over the 5 years with an expense in each year, rather than having one big expense when we buy it and nothing in the other 4 years. It evens out our accounts. It will show a fair value of the assets in a business's accounts with the cost spread over the years of use, in other words the 5 years as a cost figure. So a business, of course, will often have many assets, so the value doesn't have to be precise to the pence for each one, just overall general sensible value of our assets. We won't know the value of some of our assets until we come to sell them. So a lot of big frauds and issues, they surround the value of a business's assets. So for instance, people have overvalued their assets to obtain loans and underrepresented depreciation to improve the profits, or over-represented depreciation to reduce profits. So we're not allowed to use the system for tax calculations. So if you come across it for tax purposes, we use capital allowances and they're taught at level 4 in the business tax unit. They are, however, of course, a major expense, and therefore anything we do affects the accounting profit of the business. The business should have a stated policy. In other words, this is how we calculate depreciation on all our motor vehicles, and we stick to them unless there's a very real reason. So now on with some calculations. So we bought an asset, it cost us £12,000 and it's going to last us for 5 years. So straight line, the depreciation is going to be the same. Well, actually, the fact that we cost year 1 £12,000, it doesn't make any difference. 5 years later, it had still cost us £12,000, so that's nice and easy. The annual depreciation, £12,000 over 5 years, that's nice and easy as well. It's £2,400 a year. Now, at the end of the first year, the running total, the accumulated depreciation, is just a £2,400. Now, the carrying amount used to be called net book value, is the cost minus the accumulated depreciation. So in our final accounts, that asset will now be valued at £9,600. Well, straight line means it's going to be the same. It's a fifth. All the way down, it's going to be £2,400. But our running total will now increase. So at the end of year 2, we have our opening balance effectively. You'll see this on the ledger accounts as well. And our running total is now 4,800, which means our carrying amount has dropped to 7,200. And in fact, that will just happen again. Another £2,400 value goes down, and then all the way down another 2 years, and of course that asset is now worth 0 in our books. We've owned it and used it for 5 years, it's not worth much. So that's our simplest, most straightforward method. If you've got 100 motor vehicles, you might as well use this method, because swings and roundabouts, some are overvalued, some are undervalued. It will do a good job and keep things nice and simple for you, nice and consistent. But some assets, we know they're going to be worth some money at the end. A scrap value, or residual value is the posher term. This though doesn't change, it still cost us £12,000. So now all we've got to do is actually take the scrap value off the cost. So if I do So take the value and then divide it by the number of years. You'll see the depreciation charge is 2000, and then of course we've got only 1 years and the same principle. It's now worth 10,000. It's slightly higher value compared to the previous version. And this will be the same, so this won't make any difference. It's still straight line. The amount of depreciation is exactly the same, and this will add up the same way. So we'll start off with last year's accumulated, our running total, add in this year's, and of course it goes up in a nice straight line. And all the way down here, the difference being when it gets to the bottom, it's 2000, the scrap value it's worth in our books, the money we're going to get for it. Scrap values, of course, can be negative values as well. Some items you have to pay to dispose of them. So those are the two simple, one method plus its variation. Nice simple methods. When you've got lots of assets, you might as well use the simple methods. However, if you've ever bought something like a motor vehicle, you'll be fully aware that as you drive off the forecourt, it loses more money than it does in the next year. So if we want a truer value of our asset in our books, we use the reducing or diminishing balance. We have to pick an appropriate percentage. I've just stuck 20% in this one. So this one, we've got a cost of 12,000. So now 20% of 12,000 is 2,400. That looks actually like our first example. And this works exactly the same way. The carrying amount will be the cost. So at that point it's much the same, it's just 20% of the total. If you see scrap value in one of these calculations, it's there to trick you. We don't use scrap values on diminishing balances. These assets, of course, will never zero, so therefore we don't have to keep them for the set number of years. They will have a value 10 years time. It'll just be very little. So the difference is that the annual depreciation is not based on the 12,000. It's based on carrying amount at the end of the previous year. And then we add it. Notice it's gone down, so there's less depreciation in the second year. And of course it goes down in value, but not by as much. So this one, again, that will now be 20% of the 7,680. And this will go up the same rate. Still going up, still going down in value. It would be a curve if you drew it on a graph. And we can see actually we could just do another year. The amount of depreciation is reducing, so more in the first year, less in the second, third and fourth years. The amount of depreciation every year. So if you've got a car and it's 10 years old, you'll know that depreciation from one year to another is a couple of £100. Whereas if you drive one off the forecourt, you lose 35% as a minimum before you've got home. So it'll never actually zero, it will just go down and down and down closer to zero, and the amount, the expense reduces, hence its name, and the balance diminishes. So the other one, so this one's very rare, it doesn't happen. We have a mould or a machine tool. So our £10,000 machine tool, it will do 5,000 operations and it needs replacing. Well, 10,000 over 5,000 is £2. So if in the first year we use it 1,000 times, it will cost us 2,000. This one, of course, works exactly the same way. First year, it's only the first total, and then I'm going to type it in now. Well, the cell reference, it's now worth 8,000. So next year we've only used it 500 times, so it's only £1,000. And then of course we've got the same process plus the next year's depreciation and all the way down. So next year we've used it a lot more, most of its lifespan actually, 60% of its lifespan. So £6,000, it's down to £1,000. And if I fill the rest in, so 180, 360 that year reduces it. And we haven't quite finished, we've got another 10 operations left out of it. So there's no time scale on this or that matters. We don't need to work out how many years, which is one of the problems on depreciation. How long will your machines cost? How much will they be worth? It just depreciates according to how often we use it. Or we could actually calculate how many uses left we've got and multiply that by 2 as well. We'll come to the same answer. So ledger accounts then. So the ledger accounts are fairly straightforward, but there's a big difference between these and the level 2 account. So we use the numbers from our first example, and we've got a financial year 31st of December. So notice the depreciation expense has got a year, so it's the end of X0, so 31st. So most depreciation calculations are done at the end of the year, although you can do them part way through the year if you want, if it matters to you. And the double entry for this, I'll just abbreviate it, the running total of the accumulated depreciation account that you can see over there, and it was 2,400 for our first example. So that, one debit, one credit. So these just need balancing off. So at the end of the year, this is an asset account. And of course just brought down at the end, at the start of the next year, end of year, start of the year. However, this is different. Initial teacher did tell you about it. Expense accounts at the end of the year are closed off and transferred to the profit or loss account. No balancing carried down, no brought down. The whole amount, the expense, goes into the profit or loss. One credit entry here, debit the profit or loss account with an expense, and then we restart the account again the following year. These are going to look very similar, just different year ends. So the next year, at the end of the year, is our expense. That one's finished with at the end of X1. This one, however, we had a brought down balance of 2,400, accumulated depreciation at the end of the year will rise to the 4,800, and then of course so that is the account increasing at the end of the other year that we used here, 2,400, that's the 4,800 accumulated depreciation. There isn't an account for the carrying amount. You have the expense account, you have an asset account, and an accumulated depreciation account. So this one will look a little bit boring now, but no harm. Another 2,400, or whatever it was, of course. This is because we used the straight line method first. If it was a diminishing balance, it would be a different amount. And of course, it could actually be half a dozen different items. So in this expense account, we could have half a dozen motor vehicles with different amounts rather than just the one. I hadn't put the 4,800 in. And then you can see that one, just the amount going up, and the asset in our books will look lower. So let's have a look what it looks like in our final account. So these aren't the same numbers. So if you're a sole trader or partnership, you generally will see the three columns: the cost, the accumulated depreciation, and the carrying amount in our statement of financial position, otherwise known as a balance sheet. So notice every type of asset is normally given a separate line, each class of asset, but a small sole trader, you might list each asset. It's useful information. They understand the assets and they want to see what they're worth because they use those assets. They're their own personal possessions, effectively, if it's a sole trader. So this carrying amount is quite important. Limited company will only have one column, the carrying amount. Any calculations and explanations needed go in the notes section, and then the annual depreciation charge, profit and loss account will be a debit entry, just one of the list of expenses. And again, more details for sole trader, you might list them. One total for depreciation for limited company, but again, further explanations in the bottom of the notes section, somewhere in the notes, fairly early usually in the notes section. So just to finish off then, the general rules. So generally, unless told otherwise, you use a full year's charge in the year of acquisition. So even though we've bought something part way through the year, we charge a whole year's depreciation and none in the year of disposal. Well, we've sold it, we know what we sold it for. So there's no point having a depreciation charge part way through that year, and then if we've lost when we sold it, we didn't get as much as we should have for it. That's just too expensive, so it's pointless. Unless, of course, you're told otherwise. Makes a more interesting question from the examiners. And also, one of the other whys is that depreciation can be charged monthly. So if an asset is crucial to the value of the business, you would charge it on a monthly basis and possibly even produce a profit or loss account every month. And therefore, if you own something for 6 months during the year, that normally means that at the end of the year you've got 6 months worth of depreciation. So on our original calculations, 2,400 a year is £200 a month. If you own it for 3 months of the year, that would be £600. If you own it for 9 months, £1,800. So you look at the date of acquisition. Also, assets, of course, can be revalued to a particular value. So property, of course, goes up and isn't normally depreciated, but we might upgrade our machine. Well, effectively, we just put in the new value and then calculate future depreciations from the new value for the rest of its lifespan. And that's our depreciation. Going back to our definition, we have systematically reduced the value of an asset and worked out the charges to the profit and loss account for the use, and we've seen the value of an asset in the financial statements.